Most people think a Bitcoin crash starts the moment the price suddenly drops and a massive red candle appears on the chart. Panic breaks out, social media explodes, and everyone suddenly becomes a macroeconomic expert overnight. But that's not actually where a crash begins. By the time the price starts collapsing in a visible way, the most important part of the process has already happened quietly in the background. Decisions were made earlier, positions were adjusted, and confidence started to weaken long before most people realized something was wrong. That's exactly why Bitcoin crashes feel so confusing when you experience them in real time. One moment, everything feels normal, almost boring, and the next moment, it feels like the market has pulled the emergency brake without warning. People ask themselves what just happened, as if someone flipped a switch behind the scenes. In reality, crashes don't appear randomly. They follow a sequence, and that sequence repeats itself again and again, almost like the market is stubbornly rewatching the same episode. So instead of guessing bottoms, blaming headlines, or assuming everything is manipulated, it helps to slow things down and look at what's actually happening beneath the surface. Not just from the chart, but from the behavior inside the market itself. Once you understand how a Bitcoin crash unfolds step by step, it stops feeling chaotic and starts making a lot more sense. A Bitcoin crash almost never starts with price itself, and that's one of the biggest misunderstandings people have. Most of the time, the market still looks healthy at first glance. Bitcoin might be trending upward, sentiment is generally positive, and confidence is high. People feel comfortable holding their positions, conversations are relaxed, and optimism feels justified. On the surface, nothing looks broken, which is exactly why nobody is worried yet. Underneath that calm surface, however, expectations begin to shift. Maybe inflation data comes in slightly higher than expected, or central banks hint that interest rates could stay elevated longer than markets hoped. Sometimes it's regulatory uncertainty, geopolitical tension, or institutional investors quietly reducing exposure without announcing it on Twitter. None of this creates panic immediately. There are no dramatic headlines or urgent reactions, just a subtle change in confidence that most people barely notice. Markets don't collapse because of one bad headline. They collapse because the balance between buyers and sellers gradually changes. When fewer participants are willing to buy at higher prices, the market becomes fragile. It can still move upward, but it reacts more sharply to negative information. It's like a structure that's still standing, but only because nobody has leaned on it yet. Eventually, something acts as the trigger. This could be a disappointing economic report, technical problems at a major exchange, or a large Bitcoin transfer moving on to an exchange wallet, which suddenly causes a lot of very serious speculation on social media. Sometimes it's genuinely important news, sometimes it's surprisingly minor. The trigger itself is rarely the true cause of the crash. It's simply the moment that exposes how vulnerable the market already was. The price begins to move lower, and at first the drop doesn't look dramatic. A few percentage points down, nothing that seems unusual for Bitcoin. Experienced traders barely react, and long-term holders often ignore it. But newer participants notice immediately, and this is where psychology starts to take control. Humans are wired to avoid losses, and even small declines can feel uncomfortable. Doubt begins to creep in, confidence weakens, and people start asking themselves whether this move is different from previous pullbacks. Once uncertainty enters the picture, it spreads quickly, especially when charts start looking less friendly. At this point, mechanical forces begin to amplify the move. Stop-loss orders, which are automatic sell orders placed to limit losses, start triggering as price moves lower. When those levels are reached, Bitcoin is sold automatically into the market. That selling pushes the price down further, triggering additional stop losses. What began as a controlled pullback starts accelerating, usually faster than anyone planned for. Liquidity becomes critical during this phase. In calm conditions, there are buyers waiting at many price levels. During stress, buyers step back. Not because they suddenly believe Bitcoin has no future, but because they would prefer to buy later, ideally after things calm down, which of course everyone wants to do at the same time. As selling pressure increases and buyers hesitate, price drops faster than most people expect. Then, leverage enters the equation, and this is when crashes often intensify dramatically. A significant portion of Bitcoin trading involves borrowed money. Leverage magnifies gains, but it also magnifies losses. When price drops far enough, leveraged positions are forcibly closed by exchanges. These liquidations result in automatic market selling, adding even more downward pressure. This creates a powerful feedback loop. Forced selling causes the price to fall further, which triggers more forced selling. This is why Bitcoin crashes often feel sudden and violent. It's not only emotion driving the move, but systems doing exactly what they were designed to do, just not in the way people were hoping for. As this unfolds, sentiment shifts rapidly. Optimism that dominated just days earlier is replaced by fear, frustration, and disbelief. Social media fills with emotional reactions, while media coverage turns increasingly dramatic. Bitcoin suddenly becomes headline news again, but almost exclusively in a negative context, as if it personally offended someone. For the average investor, this is when things become emotionally heavy. You begin questioning your decisions, replaying your entry in your head, and wondering whether you missed something obvious. You find yourself checking the price more often, even though each glance increases stress rather than providing clarity. Fear usually doesn't hit all at once. It builds gradually until it feels overwhelming. This stage is driven mostly by short-term participants. These are investors who entered recently, used leverage, or committed capital they weren't mentally prepared to lock up. They sell not because their long-term view has fundamentally changed, but because the emotional pressure becomes too intense. Selling feels like regaining control, even if only temporarily. Long-term holders often remain inactive during this period, which can seem confusing from the outside. While panic dominates the conversation, a large portion of Bitcoin doesn't move at all. Coins that haven't been touched in years typically stay exactly where they are, completely uninterested in the daily drama. Most selling pressure comes from traders, over-leveraged positions, and newer market participants. As fear reaches its peak, something important happens quietly in the background. Liquidity increases as sellers flood the market. This means more Bitcoin becomes available at lower prices. While this environment feels unbearable for many, it's also where opportunity begins to quietly emerge, usually without any celebration. Large investors don't buy because conditions feel safe. They buy when conditions feel uncertain but survivable. When prices are already significantly lower, much of the negative outlook is already reflected in the market. Risk hasn't disappeared, but the relationship between potential risk and reward changes. This doesn't mean large investors are fearless or always correct. They can be early, and they can remain underwater for extended periods without panicking. The difference is that they are prepared for that possibility and don't require immediate confirmation that they made the right decision. Meanwhile, the news cycle grows louder. Headlines become more dramatic, social media reactions intensify, and every small bounce is dismissed as temporary. For beginners, this environment feels overwhelming, as if everyone else has information you don't, even though most people are just reacting in real time. Eventually, the market reaches exhaustion. Selling becomes emotional rather than strategic, driven more by the desire to escape stress than by careful analysis. This phase often occurs later in the crash, when price feels terrible, but much of the forced selling has already taken place. Then a subtle shift occurs. Price remains low, sentiment is still poor, but the speed of the decline slows. Large red candles shrink, volume spikes, and selling pressure begins to get absorbed by buyers willing to step in at these levels, even if they're not feeling particularly optimistic yet. The market doesn't immediately recover. Often it moves sideways for weeks or months, creating a dull, uncomfortable silence. There's no excitement, no urgency, and no clear signal that the worst is over. Many people lose interest during this phase and stop paying attention altogether. This is often when accumulation continues quietly, without headlines or hype. Eventually, price begins to recover slowly. Small upward moves appear, followed by pullbacks that form higher lows. Nothing feels convincing, and many people hesitate, waiting for certainty that never truly arrives. By the time confidence returns, price is usually much higher. And that completes the crash cycle. From confidence to fragility, from fragility to fear, from fear to forced selling, from forced selling to exhaustion, and from exhaustion back to cautious optimism. A Bitcoin crash isn't just a price event, it's a psychological process. The chart simply reflects collective human behavior under pressure.